Hello, and welcome to Key Factors for the week starting November the 13th, 2011, providing the context for all the currency videos produced at MarketVisionTV.com throughout the week. The Forex market remains dominated by risk, but punctuated by news events. It remains best characterized by the risk train, where in times of financial stability and growth, higher interest rates reflecting higher real economic growth strengthen on board the risk train at the expense of low-yielding or disinflationary currencies or higher yielding, higher risk currencies. However, the projected fallout in the European rescue package has extended way beyond our expectation in time, but way below our expectation in distance. As a result, it has firstly kept the risk train firmly rooted at the station, in other words, freezing the markets into a state of suspended disbelief. So although it's our belief that the euro and other European risk-related markets should be much lower, they have been artificially held up, firstly by continued news events that ironically perpetuate a buy the rumour, buy the fact hope scenario, and secondly by the risk of contagion elsewhere in Europe, but also the threat to the already fragile global economic recovery, the Far East, particularly the Chinese export-led growth, and even the US and the funding of its deficit. Eventually, the euro will give way, probably when the market least expects it, probably when the news events have stopped and the real consequences can be seen, which is why we remain sellers of the euro on rallies only within the consolidation, and why one of our favourite trades is to short the DAX. Just because a market is not immediately bearish doesn't necessarily mean it's bullish. But we also remain buyers of dollars, reflected by the dollar index, which continues to follow the 1995 analogy highlighted last March. This should continue to provide opportunities, but in a risk-off environment, this implies the last dregs of dollar weakness in dollar yen and dollar Swiss, and cable remains a mirror image of the euro, distorted by the erratic and possibly prophetic euro-sterling prolonged consolidation. It also implies a prolonged consolidation for the yen crosses in yet another phase of that amazing spiral analogy before they set up the right conditions for a major reversal. Euro-Swiss should remain a market of shifting consolidations, soon to become, though, the most fascinating battle between the effective currency or peg management of the Swiss National Bank and the need in the world for a safe haven. The commodity currencies in many ways are more acute examples of volatile consolidation markets before probably major dollar reversals. And one reason is the commodity market itself. Oil continues to map out a massive and prolonged triangle consolidation that provides more downside scope than upside. And although this suggests the current rallies in gold and silver will likely fade for more consolidation, it does have implications eventually for new highs. So, plenty of opportunities for all types of trader in all types of markets. To find out more, join us on MarketVisionTV.com throughout the week or follow me, Ed Matz, on Twitter. Good luck, and of course, have a great week.